The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Now, the author of The Path of Least Resistance and the Tech Insider, David White.
And welcome, folks, to another beautiful day at TFNN, the headquarters for technical trading and investing. Of course, we've got a market that is in full action mode. It is got the Kung Fu grip, the G.I. Joe with a Kung Fu grip, and all the other stuff going on out here. It is one of these wild rock'em sock'em robot days. Going back to all my toys as a kid, always had those great language behind the games behind it. Today, June 20th in 1975, Jaws, a film directed by Steven Spielberg, made countless viewers afraid to go into the water, opens in theaters. The story of this great white shark that terrorizes the New England resort town became an instant blockbuster, the highest grossing film in music history, until it was bested by the 1977 Star Wars movie. We got a little Star Wars. We got a little Jaws movie. Oh. Is that Ben Bernanke swimming in the water? Oh, it can't be. he just got swallowed. Anyway, we've got kind of a nice day going on out here. It is what it is, which I think is a fairly decent retracement setting up. We've had for a while what I thought was a bubble in the market. I think Ben Bernanke has seen that bubble. He's seen the bubble that it created in at least short-term bubble in the housing market. He's seen the resurgence of subprime loans in housing, in cars. We've seen a lot of other stuff, and of course, where the money he really wanted it to go to was no longer going to small businesses. It was only going to large businesses through a bunch of brain-dead politicians pushing through a bill on the last big blow-up in the marketplace. Basically, you have a bunch of banks that don't want to loan to anybody that actually needs the money. So we end up seeing more and more of this money go into the largest companies that don't need it. They borrow the money so that they don't have to repatriate it, but can still give back additional monies to shareholders. We've seen basically the bastardization of a lot of different markets, turning them into bubbles. And I think he wanted to pull the plug on this before it went any further. Especially when we look at the context of earnings in equities. We know that only 37% of the S&P 500 made their revenue numbers last month, but everybody kept on thinking this market just has to go higher. Why does it have to go higher? The only answer was that Ben Bernanke had the morphine, IV, heroin, crack drip going, and as soon as he's pretty much confirmed that they're going to at least turn that back a little bit, probably the idea that we are going to have at least some pullback to a level where the market has some rational fair market value, somewhere around probably the third day of January. We went basically way over it, and it continues to be a problem that's going to have to be sorted out over time. But some of the problems we had also with that was got to figure out why this thing. There it goes. Trying to keep everything organized here, even on three monitors. I have a problem keeping everything up here, including all my trading apparatus. We are at 1601 on the S&P cash. We've got 3 billion shares. How many days do I come out here at 2 o'clock and say that we've got 1.6, 1.8 billion shares, 2.2 billion shares on a big day, 2.4 billion shares on a fairly large day to start off the show. Normally, we're exiting the show with 2.4 billion shares over the last 60 days. We've got 3 billion shares, almost 3.1 billion shares. So we have the volume. We have the big candle. We have a lot of levels that the black boxes that automatically trade the market went through like a hot knife through butter. There's probably several things I want to get to. Let's do a little bit in the news, but do not be too much in a hurry to find a bottom out here. The thing, I kind of brought it up in the den earlier. We had a lot of new traders. In fact, I think it was E-Trade and a couple of the other more consumer-oriented broker-dealers had been coming to CNBC and Bloomberg and talking about the huge inflow of new day traders. That's almost always a good sign that we're probably very close to the end of a market. But the idea that every day you could buy stocks and go higher leads to one thing, and that is people putting a lot of the stocks to work on margin. When that comes back, you get 2 or 3 times the whiplash back down than you started with. So we've got a issue here that there's going to be 2 or 3 organic reasons why this market's going to sell off a lot more than anybody ever thought it would. One is as volatility goes up, the larger hedge funds and other street names are going to have to sell to keep within the level of what we've been talking about, and that is value at risk. As long as the market went up and the volatility became and stayed low, they were very easy to basically margin yourself all the way up. And a lot of funds that had kind of missed part of this rally were desperate to come back and make their numbers. And, of course, that meant putting a lot of stuff on margin. And that's why we see markets almost always walk the stairs all the way up to the 100th floor, but either take the elevator or sometimes just jump off the roof on the way down. And, we've had a nice 50-point range here in just a little over 24 hours. We've seen them try to raid the VIX and keep it lower and wash everybody out. That hasn't worked. And we're going to get to some of the news here that makes me think we've got a much bigger problem. And part of Bernanke pulling out now is to make sure that he has some dry powder. And this market is not holding on his every word to hold it up. Anyway, we've got, let's go to the news here today. If you're watching on Tiger TV or in the den, I've got a nice little board up here. I was trying to find anything that was positive on the day. This is probably, 10 or 15 minutes ago. But is there anything? We've got copper off 8 cents. I've been talking about copper as the metal that has a PhD in economics, and I said I was going to stay short no matter what until I saw copper get a bid, and it had never gotten a bid, and I stayed short pretty much through a lot of the bounce. I just couldn't see anything, but we've got orange juice down, coffee down, lumber down, sugar down, and that is the problem with markets at a high. There's almost no place to go and hide. Rice was down. Oats are down. What are you going to go back and find? We've got gold off almost $90. What do you do and where do you go and hide? The answer is in big market corrections, there is almost nowhere to hide, at least in the first 30 to 60 days. So be very careful if you're trying to catch a bounce out of here. The volume is telling us that, and then I'm going to get into some problems, structural problems in the markets around the world. Why don't we do that first, and then I'll get back to some of the other stuff. Overnight, the Shibor was at 13.8 13.4. If you haven't been listening to the show, it is the LIBOR for China, up at 13.4, 578 basis points up from yesterday. 1 week SHIBOR is at a staggering 11% up, 292 basis. This is roughly the equivalent of the Fed not being able to control its own Fed funds rate. Imagine tomorrow that there was absolutely no control by Ben Bernanke of what he could do. Excuse me. That's exactly what we have going on in China now. The title of my slide here is Criminal Minds. I watched the show early on, but it got kind of creepy. But one thing that I did pick up in there, they were always going after some serial killer, and they were always looking for what they called the stressor. The stressor was what changed to make them suddenly go out and kill 100 people. And there was almost always some reason, some stressor. They lost their job. The wife divorced them. The child died. Some people had been on a spree for a long time. But normally when something had just started, spree killings, there was always some kind of stressor out there. And I suspect what we've seen in Japan was not so much Japan as them being a lot closer to China, already seeing the problems that China was going to have. Their banking system is murky at best, a total fraud at worst. We'll probably find out over the next year just how bad it is. But I cannot emphasize the problems that someone like China, it's always been the United States gets a cold, the rest of the world gets pneumonia. We've got an economy now that can certainly do the opposite to us. If they get a cold, we can get pneumonia. And certainly the Japanese probably have Ebola at this point. And we're going to probably see that again tonight, probably somewhere around 8 or 9 Eastern time. One more whack at the Asian marketplaces. And, of course, to begin with, they moved a lot of money over here. But much like all huge bubbles when they burst that are like the Titanic, it busts in half. Everybody runs to the back end of the Titanic. It's still going down, but they will always run to the back. That's almost always a rush into equities or a rush into bonds. Everybody's always rushing from one to the other, thinking that they can get to the back of that Titanic. The only difference is you're going in the water maybe 15, 30 minutes later than the rest of the folks. So as we look at this, we're under 1,600 points on the S&P cash. The options have been telling us over the last week, and I've talked about it, that we could go as low as 1550 tomorrow, that there was a good chance that we'd at least hit 1575. I think that number is still there. It's certainly possible before the end of the day. What you don't want to be doing out here is getting brave, and we'll talk about why in just a minute or two.
The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Talk a little bit more. I've got a chart here for the liquidity crunch. Highlights an underlying financial risks in China. This comes from Barclays Research. And it's the 7-day repo rate and the overnight Shibor in China. And this is why I'm so sure that this is not just a cold that's going to go away or a fever that's going to go away in 12 hours. Or 24 hours. We're probably looking at something a little bit bigger. When you just pull back a little bit, that's fine. To this point, we've had a lot of volume today. The question is going to be whether or not anything happens. Are we going to have bounces along the way for lower? And the answer is I think we are going to have some very big bounces. In fact, if you go back and look at 2000 after the dot-com bubble burst, we had stocks that would trade from 50 back to 75 bucks that day that were 100, dropped to 50, back to 75. They were making ABCs all the way down, and people were trying to buy them all the time. There is a belief, especially when we get in a bubble, that even for probably the first 50% of the retrace, that no one ever can believe that the market can go down, and as fast as it can go down. Only after you've been through several of these boom-bust cycles Will you be as nervous, I think, as some of the older traders that we have on here as hosts typically are? I know a lot of people would say, Tom, Dave, Steve, you missed this move. Well, the answer is that there was probably, or at least we thought that it was probably, just a smaller pop above, and the answer was that there was a much better chance that there was a lot more to go down. So, you can be bullish and think that the S&P is going to go up 10 more points or 15 more points. The problem is, what if you have a 50 or 70% chance of that being true, but on the other 30% chance, you think the S&P would lose 100 points? And that is the problem. You can be bullish or bearish. I always tend to think if I'm bullish, am I going to be wrong 15 points? If I'm bearish, am I going to be wrong 85 points? Because, again, markets walks the stairs up, but they jump off the top of the building or take the elevator down. And that's the devious little thing where a lot of people make a lot of money as markets go up, and they give it all back. And if you had to be nothing but around in 2000 for at least me to see just how many people we had that were educated traders that in a blink of an eye gave what they had made in the previous 6 to 9 months back, believing that they could catch every one of the pullbacks in this market. I'm not saying that we won't have some pops on the way down, but to be extremely careful. This market, like I said, I think has been in a bubble mode since January. I don't think that there's a problem with us giving all that back, especially since we've seen the revenue sides of almost all these companies start to fade, and we've seen lower projections from the companies themselves. When I start seeing them actually get a little bullish in their companies, maybe that will change, and maybe that is no more than 3 months away. But we have significant risks. They're not just in this country. They're all over. We're in a recession in Europe. And if you look at the PMI numbers in China, it looks to me like they have a very good chance of hitting a recession themselves. And the numbers have not been good for probably 60 or 70 days out of China also. So there is a lot of reasons to be very nervous about a market that I think is only going to come back to fair value. And I think that fair value could be, 1425, 1450. I think we have a very good chance of hitting that 1575 level, which will probably be the first level of support either late today or tomorrow. So just be very careful out there, folks. Let me get back here. I wanted to look at a few other things since we had. Do we have enough time? Let's see. Maybe I do. When we were talking, or just before the show started, actually, Facebook came out with a new product. They had bought Instagram just a month or 45 days before they went public. As they did that, they spent $1 billion on it. A lot of people have been looking for Instagram to be the driver of Facebook. Facebook was down earlier. We'll talk about this when we come back. But a few things going on in the market besides the huge pullback. We'll be back in a minute.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
And as we continue to see markets in trouble, off 90 bucks on gold, we talked a little bit about that a few weeks ago. A lot of these miners had been making lows on lighter volume. I'd almost every time tried to buy gold and found out early on that commodities have a good way of washing everybody out, and then it's the time to buy. When it's extremely hated, when we start hearing that it's the end of gold, it's no longer going to be used, and when it's no longer on CNBC, when all the Paulson talk is over, I think we're probably going to find them. There was probably a good chance that 1250 would come into play. That's only, 30, 40 bucks lower. But we were looking for at least one good plunge to wash everybody out. Unfortunately, or fortunately, I think that we even have a lower number that it possibly is coming into play when we look at the numbers today, and that is if we get an additional run in a GLD and some of these other ETFs pushing out gold, we could look at certainly another $100 down on gold. But I think it's going to come on a huge move. $90 probably pretty good. I think the next move, maybe we bounce or something, but the next move down probably going to be a little bit more than $90, maybe 120, 130, and we're going to probably see some intraday reversal, and then we're going to have an opportunity to buy gold. Anyway, I wanted to look at some of the other things I had news that I hadn't got to yet. We'd been talking about GameStop. GameStop took a horrible move down, and pretty much we had a lot of people that were invested on the street in GameStop that came out and were pretty much telling everybody that it didn't matter if they didn't have Microsoft's business, didn't matter what was going on. The GameStop was fine, and they pushed back up. GameStop is one of the top 5 stocks with decent volume that is short now, and we need to avoid a lot of those short stocks, even in a market like this, because it's easy to continue to run shorts, even in a market that's down as far as this. But Microsoft did rescind its policy on the Xbox One about having an internet connection. That doesn't mean that all the vendors themselves will not have the exact same thing. So I think all that has happened here is Microsoft is not going to unilaterally impose it on every manufacturer of games or vendor of games, but almost all those games out there are using some kind of multiplayer interface. Steam is the one that I normally, almost all my games use Steam, and that keeps players from cheating and rewriting code, getting a definitive advance on the rest of the players. But every time I run that game, it checks with the server, makes sure I'm licensed. And I don't think any of these new games, especially from EA and some of these other franchises that bring $1 billion, $2 billion in, are going to be any different. So I think GameStop is probably going to have a nice pop in here. As soon as this thing and everybody gets away from being short this thing, another one of these things that might have a good play to the downside as most of these vendors start getting ready to push out the Xbox One and PS2s later this fall. Just because Microsoft's not doing it doesn't mean that the underlying vendor that makes the game isn't going to force a connection to check to make sure you're a licensed user. No different than the kind of licensing if you run Windows Vista or Windows 7 or 8. So everybody's probably just going to have to get used to the fact that there are licensing issues, and with games, a huge amount of piracy, especially in third world countries, and if just checking to make sure you have a valid license is an excellent way for these companies to not have to buy additional servers and bandwidth to handle those customers that they're probably not going to get anyway, but at least this way they're not paying for a lot of resources they're never going to use. Let's see, what else do we have? Is that it? No, there's a few things I wanted to get to. Instagram, we were talking just a little bit about that before the break. Of course, that is part of Facebook's now. Basically, this Instagram thing is, if you've never used Instagram, it's kind of a thing that makes a lot of pictures and puts them together, landscape and portrait mode, and puts different filters on them to add a little bit of interest. Pretty neat program, and especially women are very into it. But what they've added today is a mode in it where you can play 15 seconds of video. You can actually put 13 different filters on it. It's going to be available for Android and Apple iOS. This was actually to go up against a product that's out there with Tumblr called Vine. Vine, you could do 7 seconds. This one you can do 15 seconds. And if I want to look at 15 seconds of a dog or a turtle or the beach, okay, probably this isn't after and targeted at me. The question is, how can they sell advertising, and can they sell advertising to move Facebook? Today's results, or at least with this new product being pushed out, you would think maybe Facebook could at least stay at least flat. It's down 2%, down 48 cents today. I suspect that on this pullback, we're going to see Facebook come back down to 18 bucks on a profit basis. And on a book basis, Facebook's somewhere in the mid-8s for a dollar value. So they're going to really have to get on the stick in a hurry to make sure that Facebook does not collapse. Below 18 pretty much gives you $8. And I suspect that that would not be impossible. Of course, they've got 800 million users. So if they do find out a way to make money on this thing, they've got a captive audience. They've just not done a very good job of it so far, and we continue to see these weak markets. No one wants to take a chance as this is getting ready to go out and check those lows that it had not too long after it went public. And I think we're going to continue to see those kind of issues out here. Let's get back to the markets here and update my charts here for just a second. Then we're going to look at a few other ones. Of course, we saw the market kind of stop at the $1,600 level on the S&P cash. It's now down at $15.94. The options have been for the last week not changing, that this would be somewhere around $15.75 to $15.85 on the close tomorrow afternoon. It is quad witching. Everything expires tomorrow, so you'll have futures in the morning, options in the afternoon, and of course these are all the different ones. Everything is expiring, and to have this kind of volatility is also a good opportunity to make some money. Tom's going to be doing his options and trading options into expiration. You need to go to the front page of TFNN and find out about getting signed up for that if you haven't already. I think it's going to be well worth it. He's going to be doing it from 9 a.m. to noon tomorrow. But if you've ever wanted to play White Lightning and figure out how to make money fairly quickly in the market, a good opportunity. One of my favorite books out there is The Black Swan from Nassim Taleb, and there's a great part where he's actually talking about how you actually make money. And the best one is when you have asymmetric risk, when you risk $1 to make $50. And this is the kind of week, especially the kind of instability, where you have a market that can hit 1550 tomorrow and close at 1580. And that is exactly the kind of setup you need to be buying out of the money puts and calls for a dime and selling them for $2 later in the day. Now, are you always going to be successful? The answer is no. But a lot of people say buying options, especially one side of the options, is the quickest way to go to the poorhouse. You'll see a lot of people say that on different shows. The answer is if you can make 50 to 1, or even 25 to 1, if you can just be right 25% of the time, you're going to make a ton of money. The problem is that most traders can't be wrong for a day. They can't be wrong for a minute. And anybody that's listened to the show long enough knows that this is more like a game of baseball, where, if you are making $25 million a year, you're still batting 350. And, of course, no one would say anything bad about that. If you could bat 350 in the market and make $25 million a year, I think everybody would be happy. But the idea is making asymmetrical bets. There are a few times, probably 2 times on average a year, where you're going to have the opportunity to make a lot of money. And I think you probably want to be in on Tom's trading tomorrow, because I think there is every indication that conditions are perfect for making that happen. In fact, I'll be lining stuff up tonight and having all my numbers ready to go, and I'll probably be doing a little of that white lightning myself. Wanted to talk about some other things. First of all, someone asked about TLT last night in the den during Tom's show. I wanted to bring up that there were a few things going on with the TLT, and he wanted to buy. I think the guy wanted to buy it last night. What I said was there were two major gaps that went down to about 108.80, something like that. We got within about 40 cents of that today. And that's what I was looking for, at least at a minimum before these bonds start setting up. These gaps go back fairly long. Let me go ahead and pull these back a little bit more. These gaps go back to March 19th. No, the first one goes back even farther. Goes back to 9/4 of 2011. You've got another gap out here that we've already, I'm going to say we've pretty much effectively closed, but that came on 4/2 of 2012. So what is that, April 2nd of over a year ago. So we've gotten through at least two gaps. I'm not saying that we want to pick this up, but volume not too bad today so far. If my volume is right, we are getting into the spot where the TLT will make a fairly decent indication, and that is we've got two lows, major lows in this gap area. The first one, October 27th of 2011, that had 19 million shares, came to 109.82. We have a second one in March 19th, 109.69, with 14 million shares. So keep an eye on that. I don't know if my numbers are quite correct. I've seen a lot of numbers lagging in the market, so I'm going to wait later into the day and verify all these numbers. Make sure, especially in these fast markets, that you start seeing if quotes start to lag, other things like that. You want to be making sure that you're trading in the market that's in front of you, not the one that was there 10 or 15 minutes ago. But these numbers were there before we started the show and even before last night, and I was pretty sure we were going to get, at least over the next few days, at least these gaps tested in the TLT. And pretty easy to see these things, especially in the art of timing the trade charts, because, of course, it shows them to you automatically. Of course, you can always, we're almost, we got about 10 days left in this month, and that will be the end of the intro pricing on Art of Timing the Trade Charts. You can always go to the front page of TFNN and get go ahead and test drive it, 30 days money back guarantee. And, of course, it does a lot of different things like Gartley patterns we've talked about. We're going to be talking about more about those in the I think the first hour tomorrow night of Tom's show, maybe in the second hour. I never know until about 2 o'clock in the afternoon what we have for plans on Friday afternoon. But we're going to go through some of those charts, and one that I've made a lot of money on that I just went long on, and probably one of the best-looking Gartleys of all time. And I talked about a little bit about adding that one yesterday. We've got 3.5 billion shares on the consolidated New York Stock Exchange tape, and that's probably at 248 would come out to about 4.8 billion shares or 5 billion shares on the day. So look for a ton of volume, and I don't think we're probably going to have a huge move in the indexes tomorrow, probably a moderate move, maybe 25 points range up and down. So a little bit less than what we've had today, mostly on the downside today. But I think we're probably going to have a lot more of these stocks try to go and pin themselves to expiration values. We've got Apple. It has been really looking like they want to push this thing to $400 for tomorrow. Of course, option market makers are always trying to get the most out of their bucks. It's just down $5 so far today. I suspect that may be one of the ones that's going to move very well. We're going to talk about IBM when we come back.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Join Andy Hecht as he teaches you how to make money in commodities. The Commodities Hour, next on TFNN.
And Tom O'Brien was just on CNBC talking about a little bit about what I'm talking about. There are organic reasons in market moves. Margin calls are one. And he's talking about just how the GLD is going to be forced to sell gold, which is going to make a lot of people like Paulson have to sell his gold, which is going to make it basically ends up being a market-induced event. He quoted one of our great guys here that will be on the show directly after me, and that's Andy Height, about there are no rules in the liquidation. I think that there at least are some reasons for having at least some rules, and those are margin calls. You're going to get sold when those margin calls come. And that's what I keep on, positive feedback loop is the technical term. But the idea is as each loop continues, it grows stronger until the system breaks. And normally you'll have one huge move or maybe even a couple of huge moves. And then once everybody's washed out on the margin side, all those people that tried to catch the falling knife on the downside have quit. You get the washout, the capitulation that sets up the move for the next move higher in a marketplace. I just suspect that's going to be 30, 60, 90 days down the line. I don't think you're going to find anything that happens just today, especially when I look at, I've been asking Andy about copper. I think I asked him on Tuesday. And as long as I saw copper continue to move down, as long as I continue to see the LIBOR rates in China skyrocket, this is a market and a world that is under stress. It's not going to resolve itself in one day. Market did not get up to here in one day. It's not going to pull back in a single day. But we do start feedback loops, and there's a variety of reasons for them. Margin calls are one, but I would say that there's a bigger critical flaw in the market, and that is the value at risk for these bigger players. As the volatility goes up, they will be the equivalent of Paulson, forced to sell at least some or part of theirs, and we're probably going to see this market pull back until people get out of the levels of the market that they could not handle when volatility increases. There's going to be a lot of reasons to sell. There's only generally one reason to buy. That's you think it's going higher. A lot of reasons to sell. Keep the money you've got, to keep the profit you've got, and we're going to figure out just why and how deep the pockets run in a lot of these guys. Markets continue to look weak as we go into the close here. We're under 1590. Again, the options pretty much show that option market makers, we thought that we'd at least get to 1575. The outlier would be about 1550. I could certainly see us see that 1550 for a brief second tomorrow, and then maybe a pop back up into the 1575 range. But don't be surprised. The other thing is statistics. I want to always remind everybody that in reading charts, reading any kind of technical data, if you look at a 100-point move in the Dow and a 500-point move in the Dow, the 500-point move is not 5 times more than the 100-point move. It's a 9.3 or 9.4 in that. So as the volatility increases, it's not flat. It's not linear. It is logarithmic, and we see these huge movement days like today, where we're down already at 2.5% on the S&P cash, can get accelerated. Be very careful if you're trying to buy the bottom of this market. I would suspect we might have an opportunity in the morning for a quick trade, maybe in options, and sign up for Tom's show from 9 to noon tomorrow on trading options during expiration week. See you then.